Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're focusing on American International Group, Inc., AIG, a global insurance company providing a wide range of property casualty insurance, life insurance, retirement products, and other financial services. AIG has a significant presence in markets worldwide and plays a crucial role in managing risk for individuals and businesses alike. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's get started.
AIG has been a prominent player in the insurance and financial services industry for many years. From a behavioral finance perspective, how do biases like risk aversion and hindsight bias influence their decision-making, especially in areas like underwriting and claims management?
Risk aversion is a central theme in AIG decision-making processes, particularly in underwriting and claims management. Risk aversion refers to the preference for avoiding losses rather than pursuing equivalent gains. In the insurance industry, this bias is critical as AIG must balance the need to provide comprehensive coverage to its clients while managing the risk of large payouts. AIG's approach to underwriting involves carefully assessing the potential risks associated with each policy, ensuring that they can adequately cover claims without jeopardizing their financial stability. This conservative approach aligns with the risk-averse nature of the industry, where the focus is on minimizing potential losses. Hindsight bias, another key behavioral finance concept, also plays a role in how AIG handles past events and their impact on future decisions. Hindsight bias refers to the tendency to see events as having been predictable after they have already occurred. This bias can influence AIG post-event analysis, particularly in how they assess claims and adjust their underwriting criteria. For example, after a significant natural disaster or financial crisis, AIG might reassess their risk models and adjust their policies. Hindsight bias, another key behavioral finance concept, also plays a role in how AIG handles past events and their impact on future decisions. Hindsight bias refers to the tendency to see events as having been predictable after they have already occurred. This bias can influence AIG post-event analysis, particularly in how they assess claims and adjust their underwriting criteria. For example, after a significant natural disaster or financial crisis, AIG might reassess their risk models and adjust their policies to reflect lessons learned from those events, potentially leading to more conservative underwriting practices in the future.
And this focus on leveraging risk aversion and hindsight bias has helped AIG navigate the complexities of the insurance industry, especially when dealing with unpredictable events and large-scale claims.
Exactly. AIG's strategic use of risk aversion in underwriting and claims management, combined with the lessons learned from hindsight bias, appeals to investors looking for a company that balances financial stability with comprehensive risk management. However, this approach also means that AIG must carefully manage the risks associated with market volatility, regulatory changes, and competitive pressures, particularly as the insurance industry continues to evolve with new challenges and opportunities.
Let's talk about diversity, equity, and inclusion at AIG. As a major player in the global insurance industry, DEI is particularly important for AIG. How does this intersect with behavioral finance?
AIG's approach to DEI is crucial, especially as the company operates in a global and highly competitive industry where inclusivity can drive better decision-making, innovation, and employee engagement. From a behavioral finance perspective, strong DEI initiatives can enhance AIG's ability to innovate and adapt by fostering a culture that values diversity and inclusion. A commitment to DEI allows AIG to attract and retain top talent from various backgrounds, which is essential for maintaining its competitive edge in the insurance industry. For investors, AIG's focus on DEI can signal that the company is socially responsible and aligned with modern societal values, which can enhance its reputation and appeal to ESG-focused investors. Additionally, DEI efforts can help AIG build stronger relationships with employees, clients, and communities, reinforcing its brand as one that values inclusivity and ethical leadership.
Investors are increasingly considering DEI when evaluating companies, especially in industries like insurance, where the ability to foster inclusivity and innovation is critical to long-term success.
That's right. By embedding DEI into their corporate culture and operational strategies, AIG not only improves its ability to serve a broad range of stakeholders but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to market adaptation, AIG operates in a highly regulated and risk-intensive industry. How does the company adapt to changing market conditions and regulatory environments, and what role does behavioral finance play in this?
AIG's strategy involves continuously adapting its product offerings, risk management practices, and regulatory compliance efforts to meet the evolving needs of the insurance market while maintaining its focus on financial stability and client satisfaction. From a behavioral finance perspective, this adaptability is crucial for managing the risks associated with market volatility, regulatory changes, and competitive challenges. AIG's ability to understand and respond to new market trends such as the increasing demand for cyber insurance, the shift towards digital insurance platforms, and growing importance of sustainability and risk management allows it to stay relevant and competitive. By using data analytics, client feedback, and market research, AIG can identify emerging opportunities and adjust its strategies accordingly, helping to mitigate risks and capitalize on new opportunities in the insurance industry.
And this adaptability is essential for AIG, especially as they face competition from other insurance providers and the growing demand for more specialized and innovative insurance solutions. Their ability to maintain their brand's relevance and leadership in a changing industry is key to their continued success.
Exactly. AIG focus on understanding market dynamics and adapting its strategies accordingly allows them to remain a dominant player in the insurance industry while staying ahead of emerging trends and challenges. However, this also requires them to be proactive in responding to changes in regulatory landscapes, technological advancements, and competitive pressures.
Now, let's compare AIG to other companies in the insurance and financial services sectors like MetLife, Prudential Financial, and Chubb. How do the behavioral finance dynamics differ?
AIG dynamics are often compared to other insurance giants like MetLife, Prudential Financial, and Chubb, particularly in their approach to risk management, client engagement, and competition. AIG's strength lies in its comprehensive range of insurance products and global reach, appealing to investors looking for a company that balances financial stability with market leadership. MetLife, with its emphasis on life insurance and employee benefits, appeals to investors interested in a company that prioritizes scale and diversified services. Prudential Financial, known for its leadership in retirement planning and investment management, attracts those looking for a company that is driving advancements in financial planning and wealth management. Chubb, with its focus on property and casualty insurance, appeals to investors interested in companies that integrate risk management with operational excellence. AIG behavioral finance dynamics are shaped by its reputation for risk management, strong market presence, and adaptability, making it an attractive option for those seeking stability and growth in the insurance industry.
And unlike MetLife, which focuses heavily on life insurance and employee benefits, AIG's strength lies in its specialization in a broad range of insurance products and global operations, appealing to a different type of investor in market.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For AIG, the focus on risk management, client satisfaction, and market adaptability provides a unique value proposition in the insurance industry.
To sum up, American International Group, Inc.'s approach to business is deeply influenced by behavioral finance principles, whether it's through their risk management strategies, adaptation to changing market conditions, or their approach to DEI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives AIG's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.